Welcome to the Explainer. Today, we're doing something a little bit different. We're going to turn our screens into a high-stakes, data-driven laboratory. We're literally putting some of the most popular trading strategies through an absolute stress test. We're looking at precision entries and entry modules and breaking them down to the absolute molecular level. We need to find out what actually works when your live capital is on the line. Okay, let's dive into this. So, imagine you've mapped out your market structure, right? And you're looking at 5 different order blocks sitting right there on your chart. Well, which one actually gets your money? Which one do you risk your hard-earned capital on? It's a huge problem because choosing the wrong one means getting stopped out way before the real move even happens. To answer that, we've got to lay our foundation first. A point of interest, or a POI, is really exactly what it sounds like. It's a specific place on the chart where we're, interested in looking for a trade setup. But here's the harsh reality check. Just spotting a block is not enough. Price can hit a POI and totally fly, or it can blast right through it like it wasn't even there. So to pass our stress test today, we need an entry module. Basically, a specific set of behaviors that confirms smart money is actually active in that exact zone. And honestly, that is our ultimate goal for this explainer. We're moving way beyond basic observation here. We're going to run a clinical stress test on these zones to find the absolute best entry modules, period. We want to completely take the guesswork out of your execution. It's all about separating the 1% of traders who execute with total mechanical precision from the 99% of retail traders who are kind of just blindly providing liquidity to the market. All right, let's introduce our first laboratory variable. Test number 1, the IDM Sweep Module. So this module focuses on a highly specific scenario. We're watching for price to dip just below our inducement level, the IDM, and grab that liquidity. And get ready for this because here is a massive data point from our testing. If price sweeps that IDM, creates an institutional funding candle, and there are absolutely no other order blocks or fair value gaps sitting below that level, the probability of a successful reversal is a staggering 95 to 100%. Seriously, it's wild. And this brilliantly illustrates exactly why this first module is just so powerful. It ruthlessly capitalizes on retail noise. The market dips just low enough to trigger the stop losses of early buyers, right? And at the same time, it invites all those breakout sellers to enter the market. It's a beautifully clean trap and reverse move. It catches retail traders leaning entirely the wrong way, which is exactly what fuels the true move higher. So let's move on and see how this builds into our next variable. Test number 2, the first order block. Now you might be wondering what happens if the price doesn't just sweep that inducement level, but actually closes below it with a full candle body. Well, when that happens, the trap is officially invalidated, and we look immediately below it. Sitting right under that IDM is usually a completely fresh order block. Depending on the broader trend we're in, this is going to act as our primary supply or demand zone. The liquidity up above has been taken, and price is now driven directly into a fresh, completely unmitigated area of interest. The rules for this second test are incredibly simple, but you've got to strictly follow them. First, you identify that fresh block right under the IDM. Then you wait for price to hit it. But here's the absolute most important part. You do not front-run the trade. No way. You have to wait for a clear rejection off this block. That rejection, that's your signal. It validates the zone and gives you the total green light to execute a highly favorable, high-probability entry. Which brings us to test number 3, the last stand. Okay, we all know the market can be super unpredictable, right? Sometimes it just burns right through that first block. When that happens, we shift our focus to the extreme order block. Think of this as your ultimate fallback zone. It's the very last block sitting right before the overall trend would officially reverse, which, as you know, is the change of character, or CHoCH point. Because of where it's positioned, this is literally the safest place on the entire chart to put your stop loss. For the market to actually hit your stop, it would have to completely break its entire structural trend. And because it requires a complete trend reversal to fail, just take a look at the math here. These extreme order blocks hold roughly a 90% win rate. The logic here is pretty bulletproof. If this last stand fails, well, the entire trend is over anyway, so you shouldn't even be looking for trades in that direction in the first place. 10% of the time, sure, you take a very small, safe loss, but 90% of the time, you're catching the absolute bottom of the retracement. Moving on to the catalyst. Elephant splash confirmation. So we have our zones tested, but how do we actually pull the trigger? This right here is the true secret sauce of our stress tests. displacement. Now, what's really interesting about this is the analogy. Think of your point of interest like a swimming pool. If a small child jumps in, you get a few ripples, sure, but the water stays mostly calm. That's your retail noise. But if a massive elephant jumps into that exact same pool, water violently splashes everywhere. The pool's surface is completely and utterly disrupted. That massive disruption is smart money displacement. You don't want to trade the ripples. You want to wait for the elephant.
So let's logically walk through the exact refinement mechanics to trade that splash. First, you wait for price to hit your 30-minute higher timeframe POI. Second, you drop all the way down to the 1-minute chart. Third, you do absolutely nothing until you see the elephant splash. You're waiting for those huge, aggressive candles that break structure and leave behind a 1-minute fair value gap, or FVG. Finally, step 4, you enter when the price returns to fill that tiny 1-minute gap. This top-down approach secures an absolutely massive risk-to-reward ratio, simply because your stop loss is microscopic compared to your higher timeframe target.
Let's get to the final verdict, the results of the stress test. We've run all the variables. We've looked at IDM sweeps, first order blocks, and the extreme last stand. We've added the crucial catalyst of displacement. And the final verdict basically comes down to this golden rule. Never trade a POI blindly. Just let that sink in for a second. Honestly, it doesn't matter how beautiful a block looks on the 4-hour chart. A higher timeframe zone must always prove itself. It has to prove that smart money is defending it by showing you that lower timeframe displacement, that big elephant splash, before you risk a single dime. Now, if you want to take these mechanics from our lab today and put them into the live markets, we've made it super easy for you. You can download the complete POI and entry module PDFs with all these rules absolutely free right on our app. I also highly encourage you to join our active Discord community. You can literally watch students executing these exact mechanical rules and catching these precision entries every single day. And make sure you're ready, because in Lesson 7, we're going to be moving into advanced block types. Because all of this leaves us with one final kind of lingering question, and it's a question we'll be tackling in the next explainer. What happens when the ultimate block fails? What do you actually do when that extreme last stand order block gets completely smashed? Well, stay tuned to find out exactly how we use breakers and mitigation blocks to turn a failed zone into massive profits. See you in the next explainer.